Well, hi there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, September 3rd. We're coming to you live here from a beautifully sunny Redmond, Washington. Great to be back with you here. We took about 3 weeks off in the month of August. It was much needed. It had some personal things happening, kids going all over, daughter in boarding school. Now back safely here, at least some of us back in Redmond, Washington, and excited to be looking at the markets here. You know, it's so funny. I prepare for this show, right? I mean, I'm looking at charts all day long. That's kind of what I do. But I start preparing for the show about an hour before kickoff, right? Right, going into the close, I'm usually starting to look at things. And now that we're doing it 2 p.m. local time for me, 5 p.m. Eastern, I have a chance to just sort of reflect on the last hour of trading. We used to do this right at the closing bell, and moves like we saw today were completely disorienting because I would have like a whole narrative. I would have like a title for the YouTube video already set in my mind. And then today you have this big rip to the upside. Last 30 minutes, all buying, taking us back toward the highs of the day, saving this day from what was sort of an underwhelming, meager reaction to the jobs data this morning. So overall, great finish with just an incredible run to the upside going into the close. It's not all great, though. And I'll tell you, as we look at some sectors, energy is probably the most obvious example of something rolling over today. And you're seeing stocks like Alphabet having pretty remarkably strong days. Apple as well, gapping higher. We'll look at both of those charts. But, you know, top of my mind right now is the seasonality of where we're at in September. Now, I'll tell you, when we're talking about seasonality, right? September is usually a pretty weak month for stocks. Remember, that's not a guarantee. Just because September is usually down doesn't mean this September is going to be down. Reminds me of if you follow sports, like you follow a football team, and they come up with some stat like, well, when this team's leading at halftime, they only lose 5% of the time, but this could be that time, right? I mean, it's all about what's happening right now. So I think charts are a great reminder that regardless of what you think should happen or may happen, let's focus on what actually is happening, and let's talk about key levels to pay attention to with the S&P and elsewhere. With that in mind, as I mentioned yesterday, my goal is to make this a little more concise. I don't want to make it too concise because part of my process is kind of talking a little more stream of consciousness about what I'm seeing. That's kind of my approach. So I don't want to change that, but I don't want to ramble on too long. So I'll find that Goldilocks period. It was a little over half an hour yesterday. We'll see what happens. With that in mind, let's look at the charts together. And again, great to be back with you guys. Seeing a lot of nice comments as we come back with the show, and I appreciate all of them. S&P finishes up about 0.5%. It was basically flat for the day around 2:45 p.m. Eastern time, but by the close, we're back up toward the highs, pushing 64.50. So that's, again, decent up day. With the last 30 minutes being pretty much the gain. The NASDAQ composite actually outperforming up about 1% today, also had a late stage rally. But, the concern, I think the challenge to this market in the last couple of weeks has been mega cap growth has not really been participating. Today, we saw a change to that, right? Top three sectors are all kind of the growthy, Mag 7 types of sectors. So this was very much a risk on day for some of those leading growth names, many of which charts have been kind of underwhelming recently. Mid caps and small caps both ended up closing slightly lower. They all had that late half-hour rally, but these had been sold off a lot more earlier in the day, so weren't quite able to get back to the zero level. The VIX drifting lower today, not quite a full point. It was around 17 until the late stage rally, and so the VIX came down as stocks rallied to that fear gauge back around 16.3, 16.4. This is a low volatility environment until we start pushing 20. We're not there today. Looking at the bond markets, bonds rallying today. I was on the Forex Analytics Face interview with Dale Pinkert earlier today. So shout out to my friends there, Dale and Blake and the team at Forex Analytics. Fantastic group of traders, really more thinking about short-term movements in currencies and other markets as well. And I always enjoy sort of comparing notes with those guys and seeing what I'm seeing. We talked a little bit about the bond markets, and the TLT up today about 1.1%. The chart of the TLT, we'll see if that's a move that continues into the remainder of the week. But higher bond prices means weaker yields, and the 10-year Treasury yield getting down to the lower end of that range. We're talking about 4.2% as being sort of the floor in the 10-year. here in recent weeks. The market, of course, pricing in today with the rally in bonds, rally in stocks, kind of pricing in a rate cut, sort of the general message I think the market told us back after this morning's jobs data was, just pretty much the Fed is going to lower rates at the September meeting here coming up later this month, and then we'll see from there. But that's now basically priced in as a 100% likely. It's not quite. It's like 80-some%, but pretty much the likely scenario. As a result, today bonds rallying, yields coming down. 10-year yield still holding above 4.2%. Long bond yield around 4.9%. Dollar slightly lower today. We just recorded earlier today top 10 charts to watch for September 2025. I recorded that in the Stock Charts TV studio with my good friend and former colleague Grayson Rose. And we talked about silver. That was one of my 5 picks, not the SLV, but a different silver minor ETF. I would encourage you to check that out. It'll probably be out tonight or tomorrow on the Stock Charts TV YouTube channel, but great discussion about 10 different charts. We each contributed half of those and then debated a lot of the merits of them from a technical perspective, talked a lot about seasonality and sort of broader themes in relation to those, sort of stock picks. So I'd encourage you to check that out. But, shout out to gold and silver continuing to push to new all-time highs today. Gold rallied significantly yesterday and continued to push to the upside. The GLD making a new all-time high, drifting above 329 earlier in the day, settling down around 328. That's still up about 0.8%. I do have a position in GLD here. I also have positions in Bitcoin and Ethereum. I did trim Bitcoin a little bit today, given the choppiness that we've seen recently, and it's done so well. I've got a little too much of a position probably in Bitcoin at this point, so trimmed a bit of it, but I still own a number of Bitcoin ETFs and also spot Bitcoin and Ethereum. Today, Ethereum continued to outperform. Right? The Ethereum over Bitcoin trade has been pretty good. Ethereum up over 3.2% today, 44.65 or so on Bitcoin. We're up about 1% today, back up above 112,000, which is good. We were down around 108, 109,000 coming out of the weekend. The rest of the top 10 coins mostly higher today. Looking at the 11 S&P sectors here: communication services, technology, consumer discretionary. These are your 3 Mag 7 kind of growth sectors, and they were all up, and that was it. Everything else was down. Even with the market rallying into the close, most things actually finished lower today. And energy, definitely the worst performer, down over 2%. You'll see in a moment when we look at the market carpet, sort of heat map style visualization, big concentration of the color red in the XLE members, as you'll see in a moment. Materials and industrials, two of the other cyclical sectors, down as well. So this was very much a growth over value day, sort of a Mag 7 over everything else day. The big moves in Alphabet and other leading growth names. I would argue in many ways the story here. Breadth conditions got a lot better with the late stage rally and ended up being sort of neutral, right? The visualization we're looking at here on stock charts, this is on the market dashboard. And there's a widget called Advancers Decliners, and it's a great, just kind of simple visualization looking at the 5 major U.S. indexes and looking at how many stocks were up or down, and it's color-coded from very bullish to very bearish. And as you can see, they're all in a neutral kind of yellowish amber beigey color. For the New York Stock Exchange, 50% up, 47% down. The NASDAQ Composite and the S&P 500 a little more leaning toward decliners, still about 55% down versus 45% up. This was not a big distribution day. That rally at the end of the day made this a lot more neutral at this particular moment. We're going to talk about Alphabet in a minute. I just want to highlight the strength that we saw, not in all the Magnificent Seven stocks, right? It's noteworthy that Meta, Amazon, Microsoft, Nvidia did not have particularly great days, but Alphabet was up over 9% on positive news for their business. Apple also starting to become a pretty compelling chart here, making a new swing high, up over 3%. The Mags ETF up about 2.5% today. So out of the Mag 7, it wasn't like the whole group was up. It was Alphabet and Apple as sort of the 2 positive outliers, having remarkably strong days and dramatically outperforming the major benchmarks. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. It is awesome to be back with you doing the show. It was great to have a break. I miss doing the show, though. I really do enjoy it. It's so much a part of my process, and it helps me to sort of collect my thoughts at the end of the day and helps me sort of articulate what I'm seeing after the day of analyzing charts and having discussions with people. So I appreciate the questions coming in on all of those platforms. Anywhere where you can put a comment if you're watching live, I can see those on my live streaming platform. If you're watching the replay on our YouTube channel, any questions that come up during the show, just put it in the comments section below the YouTube video. Anything we don't get to on the show, we'll put in our mailbag, and we're planning an all mailbag episode on Friday of this week. Here's the heat map. And what's interesting is if you ignore Apple and Alphabet, which are obviously the two significant positive outliers, and if you cover up the energy sector, which is pretty much all down, the rest of the heat map was kind of right? Kind of a meh, kind of a non-day, right? There just wasn't much happening here. And areas of the market that have been showing some strength, like financials come to mind. A lot of those are pretty decent. Breakout charts are very close to breakout levels. They really didn't follow to the upside too much today. Now, some of these looked worse and then rallied at the end of the day. But, overall, this was sort of a story of some individual names having some significant moves. Otherwise, it's sort of an underwhelming day all around. Obviously, we've got some further jobs data through the course of this week that has some market moving potential. It's almost like the market's treading water going into that period. Having said that, right, let's focus on those outliers. So Apple and Alphabet, I would say out of the Magnificent Seven charts, definitely the strongest, right? You have names like Nvidia, names like Broadcom, names like Meta, and I grabbed a couple of those we'll look at in a minute, but those are all pulling back, right? They're pulling back to pretty clear support levels. And most of those aren't really bad charts yet. They're just not great charts, right? They're kind of okay as they pull back to previous support, but they haven't broken down. Apple and Alphabet starting to differentiate themselves by having very positive technical structures. And it's important to think about how different charts like Alphabet and others relate to other charts that you could be selecting, right? And so I think the strength there needs to be respected. A lot of people have been avoiding energy, and we've certainly not been particularly keen on owning a lot of energy, given the perpetual weakness that you see in crude oil prices. It's just been, those prices have been kept so low, and so many of these companies make money when crude oil prices are higher than this. So names like Halliburton, which are down 4%. I mean, they weren't great charts, right? And they were sort of struggling to get a headway or get a breakout above key levels. Charts like Halliburton are sideways charts. They're neutral, right? If you think about a chart, is it up, down, or sideways? This is sideways at best. And we can define that from a technical perspective on the fact that $23 is kind of the level, right? That's the limit. We haven't been able to get above there. What's happening is the 200-day moving average is getting closer and closer to that 23 level, which says two things to me. Number one, we're not breaking out yet. Number two, the breakout above $23 a share, the breakout above 200-day moving average, which at some point probably comes, is going to be a pretty significant change of character. That would suggest to me that a stock like Halliburton is in a new accumulation phase, but not there yet. This is where I'm happy setting an alert. I'd say, tell me when this thing breaks above 23, and then go do something else with my time and let the market tell me when the stock actually starts to deserve some optimism. I'm also noting this is a Seattle-based company. You may have heard of them. They make coffee, Starbucks. Another one that when you look at the chart of Starbucks from a technical perspective, look at how many times over the last 3 months Starbucks has broken above the 200-day moving average and been unable to hold that breakout, right? We've had a number of times where we close above the 200-day, then immediate next day we're back below. We have stocks where we have days where we gapped well higher and then just traded back at the lows of the day, and soon we're below there. We've had a number of those days, right, where we open higher and close back below. And then most recently in mid-August, we've just been unable to get there. The 200-day moving average for me is just a basic litmus test. Is this the type of chart that I should be kind of interested in or not? And stocks generally above the 200-day, I'm way more interested in for whatever reason, because that tells you that there's enough accumulation happening that we're above that kind of long-term trend mechanism, right? So for me, I think the fact that Starbucks is down is less the story. It's more the fact that we're just not getting above there. And until and unless we can get a foothold above the 200-day moving average, I'm inclined to be very patient and look for opportunities elsewhere. So Starbucks back down to testing support around 85. A breakdown there basically unlocks a retest of the April lows, which is not particularly encouraging. I think that's it for here. I mean, last maybe general observation to keep in mind, check out consumer staples. Again, not great, but I mean, big box retailers bouncing higher. Some of the food names like ConAgra, I mean, these are not great charts because they've been going down for a lot, but they're starting to break out. Maybe start to be on the new 3-month highs list, which is a list that I review very often for potential breakouts. A chart like Clorox is not a good chart. It's not. But is it a big double bottoming pattern and starting to rotate higher? Not the type of chart I normally buy. I'm not a big fan of buying lows. I'd much rather buy things when they're breaking out. So this is the kind of chart I'd be interested when it breaks above 130. But if you're more of a mean reversion player, if you're more of a swing trader, I don't blame you for trying to buy a double bottom pattern and maybe retesting a swing up to 130. I get the argument. See if we can get above the 50-day. That's where we stalled out a number of times here in the last 12 months. All right, shall we finish off and go to some charts here to finish our discussion? The S&P daily chart, earlier in the day, it looks like we might be breaking below the 21-day exponential moving average. That is an initial line in the sand that I always pay attention to. We actually opened below the 21-day EMA yesterday, but closed back up to it today. We opened higher, traded down almost precisely to that 21-day EMA, and then close back at the highs of the day. So we're seeing a couple days here where we're seeing accumulation happen during the trading day, right? So Monday was off. Tuesday, we closed at the highs of the day. Today, we basically closed at the highs of the day. I think that tells you the short-term momentum is pretty decent here. And so for me, line in the sand, 63.50. I think anything above there is just normal market activity. We break below 63.50. That would be a new swing low. That would also be a break of the 50-day moving average. That'd be pretty bearish, in my opinion. At least, expectation would be we'd unlock a retest of the 200-day moving average, currently just below 6,000. Also note, again, this most recent new all-time high marked by weaker momentum. There are a lot of charts that have that bearish divergence. One of the items on my market top checklist, which I realize I need to start dusting off for my market misbehavior premium members. I'm actually going to write that down right now. So I have a tendency to say things out loud, and if I don't write them down, nothing ever comes of them. That is my lot in life. I wrote it down. All right. So one of the items is a proliferation of bearish momentum divergences. What happens in a healthy bull market? You look at like Nvidia in May, June, July. Look how we're making new highs, and look how the momentum is just consistently pretty strong, right? We're making new highs in late June, RSI overbought. We're making new highs in mid-July, RSI overbought. Even at the end of July, coming off of it, but still underbought. But look at the new high in August, or at least the attempted new high. Look at this most recent attempt to get above 185. The RSI is down here around 60. So this is what a healthy momentum picture looks like when the uptrend is really firing on all cylinders. Stocks become overbought as they thrust higher because a lot of people are excited to buy into that breakout. When there's less accumulation happening, number one, we fail to make new highs, which is what's happened in August for Nvidia, but we're also doing it on weaker momentum. So every test of the previous high is with weaker and weaker RSI. And that's usually what happens at the end of a big uptrend phase. You have that early warning of distribution where there's selling off happening. It's just not being really reflected too much in the price of the stock. Now, Nvidia, as we mentioned on yesterday, I don't know if I mentioned this on the program, but basically looking at the 50-day moving average to see whether it can hold. Yesterday, we closed just slightly below the 50-day moving average. Today, an almost identical day. So we're not really getting follow through to the downside. I don't think that level's broken yet. But for me, 170 was the alert. It fired again today. Waiting to see when we close below that level. But I would say if we get a close below 170, if we get an RSI pushing below 40, that would be a very bearish development for one of the previous leadership names. And the question is, can the market go up? If Nvidia is going down, it can. Would I expect the market to go up significantly if stocks like Nvidia are breaking down? Maybe not, but the leadership is going to probably go somewhere else, and other sectors is where I would think maybe some of that strength starts to emerge. Now, while we have some communication services names like Alphabet ripping to the upside, up almost 9% today, you have Meta, which was up slightly, but I think the story for Meta is this pink line that I've drawn on my chart, which is what we call a pivot point. A pivot point in terms of technical analysis terminology is a level that has importance on the chart, quite simply, right? So a level that is tested as resistance and support. It's the level that keeps coming up. As you're looking horizontally, you're looking at what levels where we tend to have significant moves. This is what a pivot point kind of looks like. This was the high in February, going into that sell-off into the eventual April low. We round tripped it all the way back up to 740 is about the dollar level here at the end of June. We pulled back. We finally gapped above that. And then look at how we've now had a couple bounces down to that pivot point. Now, we closed below the 50-day moving average yesterday, but closed back at the highs of the day. Today, we're right back at the 50-day. So I would argue this level is still sort of in play. But, so the bull case here is we've had a breakout and then a pullback to the breakout level, which is a classic technical setup before the next move higher. I mean, buying the pullback to the breakout level is a pretty good approach, but you always want to have a good stop in mind, because the problem is if we fail to hold that breakout level, that means anyone that bought here after that gap is now underwater. That's when people start to get nervous. That's when people start to not be optimistic, and they start to panic sell. And that's what causes additional distribution, which causes the price to go lower, which causes more panic. And we get that feedback loop of price downturning. So I'd say Meta, another key chart to watch this week. And again, I think, overall the setup, I'd probably bet on this being a nice pullback, to the next leg higher. But if I'm taking that shot, which I'm not right now, I'd be keeping a pretty tight stop, because this is very close to looking like a breakdown scenario. Now, Alphabet, of course, making new highs yet again today, gapping with authority above 215 all the way up to close around 230. That's up over 9%. It turns out this is a stock that's been performing quite well. Out of the Magnificent Seven names, look at the price action in August. Forget about today. Look at the month of August versus like Nvidia, which is flat, versus Meta, which is pulling back. This is a stock that's actually trending higher that whole time. So Alphabet has been a positive outlier going into this week, but today with the positive news, basically, allowing them to continue to use the Chrome browser and some things that they're doing, obviously a significant win. The threat to Alphabet is obviously just dramatic changes in consumer behavior and the use of technology. I don't know about you, but I don't look at the Google website nearly as much as I used to. I used to have that up as like on one of my monitors because I was always Googling things. Now I have ChatGPT up on this other monitor more than I have Google, because I'm asking things of, it's like a research assistant as opposed to, asking a caveman for help, which is how you would talk to Google. It's in phrases. With ChatGPT, you're actually talking to it like a human being. So it feels more natural. I'm starting to see results that make more sense to me. Having said that, this is obviously a positive news for Alphabet, and if they continue to dominate in the world of browsers, which we're all still using for a while, as far as I know, pretty good news for the stock. From a technical perspective, that's innocent until proven guilty. The strength in Alphabet has been there all through July and all through August. I think this just continues the uptrend that we've been following. Apple, a really compelling chart here, and I think the gap higher today is pretty important. Not just because it's a new 3-month high, which for me is always an important thing. Remember what we talked about with Meta, the breakout and pullback to the breakout level. Look at 225 and how we broke above that. It's actually a Fibonacci level, and also the swing high from the end of March. It was right before we accelerated down into the April low. The 38.2% retracement level ended up being pretty significant. Most recently, the bounce there in early August. We traded just above the 61.8% retracement level, and now with health. So I think this is an exceptionally good chart above 225. And that's how I would think of when you think of like structuring a trade using technical analysis. I would use some of these key levels, particularly levels that have been validated with price action, with support and resistance. 225 is a clear level to rely on. Things, action above there is pretty encouraging. Now, the gap higher today is encouraging because it eliminates what looked like a bearish divergence. It almost looked like we might, if we had a rally on weaker momentum, that would be kind of a concern. You're actually seeing a rally on stronger momentum, stronger relative strength. I think that's a pretty decent chart here. So within the Magnificent Seven stocks, you almost have the haves and the have-nots, right? You have some of these stocks charts that are looking very constructive. Alphabet obviously making new highs, but like Apple just starting to break out. You have tactical pullbacks like Meta, and I think with things like Meta and Nvidia, the question is, do we hold that support? I think it's too early to determine what, but with stocks like Nvidia, I see a lot more to be concerned about, particularly in terms of the bearish divergences. Always a concern. All right, let's take a question from X. Marlon, I don't remember taking a question from you before, and I so appreciate you tuning in live on X, the former Twitter. Long questions. Let's summarize. Something in the air that the market is at edge to the downside. I would wholeheartedly agree with that. Dollar down, end of Fed, Powell. I don't know about that. I mean, I think that's going to naturally run its course into next year, but we'll see. I mean, I've been surprised by plenty of things. Precious metal up, Trump Epstein release file, battle war, Fed's cook battle. The Fed rate cut could change in a dime with next week data. How are you hedging and what are you nibbling on cautiously? Yeah, so that's a really interesting question. And I will tell you, for me, I always differentiate the macro call, right? What do I think about the S&P? What do I think about seasonality? What do I think about breadth data versus positioning, right? So for me, the way that I think of things from a technical perspective is I'm a trend follower primarily, right? So I have a market trend model that tells me what are the trends on 3 different timeframes. As of Friday's close, my market trend model remains bullish on all timeframes, and except for one brief week back here at the end of July, these have been all bullish since the beginning of May. Coming off that April market low here, a couple weeks later, my model is bullish on all timeframes. That tells me to kind of be looking for long opportunities and riding the market higher. So, for me, that doesn't mean I buy particular types of charts. That would be more of a top-down approach, saying I'm bullish, so I want to buy, kind of risky things that I think are going to outperform. For me, it's about finding the right charts. And if the best charts are in technology, I want to own those. If the best charts are in REITs, even though that's a more defensive sector, if that's where the good charts are, I'm going to own those. That's why I sign off this show every time with, it's always a good time to own good charts. Now, you bring up an excellent point, which is how are you hedging? The short answer is I don't hedge a lot. Why don't I hedge a lot? I spent many, many years in my career working for big financial institutions. We weren't allowed to hedge. Just because for a number of compliance reasons, right? Weren't allowed to use options, weren't allowed to use futures, weren't really allowed to do any sort of covered call kind of strategies, which would be great things to do if you don't want to sell some big position, but you're just concerned about some potential downside. And you want to limit your losses. Those are great ways to do that. I just never was able to. And so I've developed a whole process that has nothing to do with hedging. Having said that, if I could do it all over, would I incorporate some sort of hedging? I probably would. But at this point, I've got a decent system that seems to work for me. Having said that, right? I mean, that's what I think you need to remember is with charts. When I talk about the different charts, what you do with that information, how you analyze these charts, and how that informs your portfolio positioning and your bet sizing and how much risk you're taking on. That's a crucial next step, right? Which is that money management process of how you take a technical thesis and put it into a portfolio format. For me, instead of hedging, it's more about trend following, right? So if, defensive areas of the market like bonds start to look good, and if the charts start to improve, they're naturally going to start to look better in my trend following process, and my portfolio is going to rotate to those things. And so I don't think of it as hedging like I'm concerned we might go down. All that tells me is, how many kind of new bets am I taking? And I would say at this point, I'm not taking a ton of new bets in the portfolio because I'm concerned about some downsides. I'm probably a little more risk averse right now. I'm not selling anything just because I think the market might go down. It just tells me to be cautious and be wary and to make sure that I have a consistent process of analyzing the evidence. In terms of things that I'm nibbling on, things that I would be adding to, it's charts that are starting to look good. Things that look good to me, by the way, are things that have not been looking good, right? I was talking with Grayson Rose earlier. While things like Nvidia have been on incredible runs and starting to rotate lower, what are things that have not been looking good and are starting to improve? And we've seen that most recently with gold, right, which has been really sideways for a number of months, starting to break out. I think that's compelling. Home builders, right, going higher as rates are, expected to continue to go lower. Home builders have really started to outperform in the last couple of months. Those were absolutely dogs of ugly charts. And then I'm seeing things in financials and healthcare and other sectors where the charts had been not good and are now starting to look good. That's why my process is all about rinsing and repeating, looking for stocks making new 3-month highs, because I want to find things earlier on that are starting to rotate higher. I would encourage you to have a process of your own where you can identify those, or go ahead and keep watching the show. Maybe even become a Market Misbehavior Premium member, and I'll share with you some of the charts that come up in my own process. But for now, I will say thank you guys so much for watching. Some great questions in here. I only got to one of them, but I'll put the remainder in our mailbag for Friday's episode. In the meantime, have a fantastic evening. And remember, it's always a good time to own good charts. Have a good night, folks.